Afternoon.
Afternoon, James. How are you?
Doing well, thanks. Yourself?
I'm good, thank you. Just before I forget, just give me a second. I'm just going to change to my mobile hotspot just in case my home Wi-Fi doesn't work like last time. I might be disconnected a little bit, but then we'll be back very shortly.
No worries. I've been finding my home internet's a bit slower this morning. I'm on my mobile as well.
Yeah, is that the NBN thing? I'm not sure why, but my home internet is not too great too. Just give me a second. I'm just logging in again. Okay. I'm not back yet. Am I back yet, guys? Can you hear me?
Yeah, I can hear you.
Okay, cool. Thank you. All right. So before we start today, is there any questions? So if you have read the exam information slides that I posted on LMS, is there any questions that you wanted to ask or clarify before we start?
Hi, Van. I just wanted to know that how is the final exam pattern going to be? Like, is it going to be like same like mid-semesters or something like that? Or like how?
So there will be two parts. There will be a part A with 24 multiple choice questions, and there'll be part B with 3 short answer questions.
With the same, yeah.
I will talk about them a little bit more detail later on, but the format is like that. Yeah.
Okay.
What was your second question?
Yeah, both part A and B would be having same weightage of marks or would differ?
Part A is 20 marks and part B is 30 marks. So in total, they will add up to 50 marks.
Right. Sure. And when can we see the sample things on the LMS?
I think I made it available today, but I don't remember what time. Yeah, it should be available today.
Okay, yeah. Thank you.
Yeah. So if by the end of today you don't see it yet, make sure you email me.
Sure, definitely.
So I can check the settings.
Yep, thank you.
Hi, ma'am.
Yeah, sure.
Yeah, I would like to know, like, would we be allowed to do our workings in with a paper and submit it as well?
Yeah, sure. It's the same as before. You can either submit your workings
same as
or
midterm exam, right? And it would be if you're comfortable doing it in a notebook and submitting as well.
Yeah, so you can take a picture of your work and you can submit it online.
Yeah, okay. Thank you.
So in some of the short answer questions, you might have to draw a graph or something, right? So for that particular question, you've got to use your pen and pencil, I guess, because it's very hard to draw a graph on the computer. So just bear that in mind. But for the other questions, it would just be similar to before. Okay.
Professor, have we decided on the revision before the exam, like the one something you mentioned about in the discussion forum as well, that there would be 1 hour consultation before the exam? Have we decided on the date yet?
Yeah, so according to the poll, it's a little bit divided. So right now, I think we have so most people choose Monday, the 26th. So I'm going to have a revision workshop on Monday, the 26th. And then I'm going to have 1-to-1 consultation hours by appointment. I'll talk about it later on in the last slide.
All right, thank you.
Yeah. Any more questions? All right. So if there's no more questions, I guess for today, it's going to be a short lecture. So the purpose of today is I just want to go through the format of the exam and the content of the exam, so you know what to expect when you go into the exam. Okay. I'll do a little bit of a brief revision of the previous topics that we went through. And then if you want, you can stay back for some of the questions that I can go through later on. But I think the first part of the lecture is more important. So in terms of the exam, I think all of you have already known that it's going to be on Saturday, the 31st. And I've got a question in the chat. Sorry, I'm just going to check. So is the revision lecture be recorded? Yeah, so I can record the revision lecture for you as well. That's no problem. So the duration is going to be 2 hours and 15 minutes, and the exam is divided into 2 parts. So for part A, you've got 24 multiple choice questions. This is 20 marks out of 50, and the total time allowance is 1 hour and 5 minutes. For part B, you've got 3 short answer questions, so 30 marks in total, and this is for 1 hour and 10 minutes. As before, you've got to complete part A before you can see part B. The exam is marked out of 50, and that will be, so this will be the proportion of the exam in your final mark. There is a hurdle requirement. That means you need to get at least 50% in the exam to pass the subject, okay? So out of all the 50 marks, you've got to get at least 25 marks, okay? In terms of exam question type, so as you know, this is an online exam, so the assumption is it's going to be open book. So you're welcome to have your materials with you. You're welcome to have your notes with you. However, the only thing is you cannot copy word by word, right, from any sources, either internet or so on and so forth. I've seen in the last semester that people copy from Investopedia, and sometimes they keep the link there. They forgot to delete the link. So that is really a red flag, okay? So for these cases, obviously, you're going to be reported to academic integrity, and they will decide on what is the penalty. Okay, so we don't want to go there. So so since you've got your book with you and everything, you see the answers and stuff, but just make sure that you write the answer in the in your answer box using your own words. Okay. So with part A, this is the multiple choice part, and for this part, the chapters that are examinable is chapters 3, 6, 7, 8, 9, and 11. Okay, so you just have to practice these chapters to be prepared for part A of the exam. For part B, this is a bit harder. So for part B, all topics are examinable. In part B, I can tell you that there are 2 different types of questions. The first one is a big question with 15 marks. So in terms of the time allowance, you should complete the question within about 30 to 35 minutes, okay? So this big question is going to be calculation. And I'll discuss, I'll show you some of the questions later on to see what is the length of a 30-minute question, okay? Besides, you've got 2 questions worth 7.5. So in terms of time, it's about 15 to 20 minutes, okay? So with these 2 smaller questions, they could be either calculation or theory, okay? And I've got an example of how a theory question looks like as well at the end of the lecture. So in terms of those calculation questions, I guess the best way to revise for them is to go through the tutorial questions. So I will not examine anything that is not covered yet in class, okay? So all of the calculations that we have done in class, you can expect that something similar will come up. Of course, I'm not going to give you the same exact question and number and things like that. But you could be confident if you practice your tutorial questions enough, then you can be confident that you can finish part B with high marks, okay?
Just had a quick question with part B. We can upload our files if we need a graph. Can we write, like type some of the answer and then submit the second half? Or is it best if we're going to submit something, have the full answer on that file submitted?
You can submit parts. That's fine.
Okay.
Yeah.
Yeah.
But make sure you tell me, let's say you type your answer, right? Make sure you
Sure.
tell me that the second part is in the file
Sure.
submission.
Sure. I was just, you start working, you start typing, then you realize you need it. Can
Yeah.
I just, okay, no worries. Thanks.
Yeah, that's a good question. So you can submit many parts in many files if that's suitable for you. Just make sure that you tell me where the answers is from. All right, so how to prepare for the exam. So one good way is, of course, to revise the materials and understand all the questions that we went through before. And then when you are ready, you can attempt the practice exam, right? So the format of the practice exam is going to be identical to the actual exam. So the time, for example, the length of the questions will be similar, and the time allowance will be similar, obviously. I've got a question in the chat box. What if there is a problem with the internet? So this is something I can't really solve, sorry. In the past, when people have problems with the internet, if they can fix it like within 5 minutes or so, I think they can go back to the exam and resume their answer. But if your internet is out, let's say for like an hour or so, then I guess the best way is to take a picture or something of your problem and then email me right after, okay? So I can reopen the exam for you. Yeah, sorry, with internet, then I don't really have a solution for you. But I guess the best way is just to reopen the exam if that happens. All right, so where were we? So in terms of the practice exam, part A with the multiple choice questions, the practice paper is going to cover the same chapters with the actual exam. So you know what to expect when you've got that 1 hour time window. For part B, I took the questions from the tutorials, right? So as I mentioned before, the calculation questions will be similar to what you have seen in the tutorials or in the lecture. So the type of the sample questions on LMS would therefore advise you about the time that you should spend on each of the questions. Okay, so see those. So see what type of questions are for the 30-minute question and what type of questions are for the 15-minute question. Okay.
I just had a quick question. With part A, you said certain topics are covered. Are those, you said 3, 6, 7, 8, 9, 11. Are those weeks or are those actual chapters?
They are actual chapters. Yeah, good question.
The chapters, okay.
Yeah. So they are chapters. So let me go back just to clarify. So these are the chapters numbers.
Yeah. Oh, okay. So it does say chapters there. I just had weeks in mine. Thanks.
Yeah, that's all right. Okay, so here we go. So the practice exam, just because I've got to set up I need to make sure that I set up the website properly for the exam date. So I'm going to close the practice exam on Thursday, which is 2 days before the actual paper. So if you plan to practice, make sure you have enough time or you allow yourself enough time to do the practice paper before it is closed, okay? So in terms of exam revision, as I mentioned before, for this lecture, I'm just going to go through some of the main points for the chapters we went through in class. And for each of those chapters, I'm going to point out what is the main issue that you need to understand to do well in the exam. I will finish the revision here and then I'll go through some of the examples of exam questions just to give you an idea of what to expect. And then if you have any questions, feel free to raise it at the end, okay? I also plan to arrange one-to-one consultation later on, which I'll talk about in the last slide. Besides that, I'm going to have another revision workshop closer to the date because I guess that's when the revision would start. Okay. So in terms of the exam, I could say that it is long, as in you've got to, spend the time to go through the questions. But I can guarantee that it is not something that is too overly difficult. Okay, so it's something that you have done before in class, but it is just going to be in a different context. So if you put effort in revising the materials, then definitely you would at least pass the subject, okay? Right, so as we mentioned before with with part A, I think the best way to prepare for part A is to go through the revision quizzes to practice and then do the practice paper, of course. With part B, for the numerical problems, make sure you practice the problems we have gone through in class. For the theory question though, you've got to make sure you understand the materials because I'm not going to ask you for a definition or something that you can copy straight from the text, but I want to ask you a question that you have to evaluate, okay? There will be an example later on. Right. So in the next few slides, I'm just going to talk about the different topics we went through. So the first topic that we talk about in this subject is International Monetary System, and this is chapter 2. So in chapter 2, we went through a few monetary systems in the past. We discussed the context where they were created and also the problems that caused them to collapse, okay? So, for example, with the earlier monetary systems, like the bimetallism system, the classical gold standard, or the dollar-based gold standard. So each of them had the historical importance at the time that they were created, and they were used to help international trade between different countries, right? So the common feature of these different monetary systems was that they were somehow fixed, okay? So the currency value was somehow fixed to something else. For example, with the bimetallism system, you fix the value of the gold relative to the silver, okay? With the classical gold standard, it's the same thing. So you fix your currency value against the gold. And as a result, your exchange rate is somewhat fixed because it's fixed to the gold standard, the gold reserve. With the dollar-based gold exchange standard, instead of fixing your currency against the gold, you fix your currency against the USD, right? So in all of these systems, even though the later ones were less restrictive than the earlier ones, but they all have something in common, which is that they were somehow fixed. So the problem with fixing your currency value against something is that when the real value of the currency deviate from the fixed level, this is when the problem occurs, right? So when the real value is different from the nominal value, people will arbitrage, and eventually you either have to remove the nominal value, adjust nominal value to the new real value, or the system will collapse, okay? So realizing that there is a problem with fixing currency values, later on people come up with the floating exchange rate regime, where they let market demand and supply determine the value of their currency, right? So in this case, the market value of the currency always reflect the real value of the currency. Did someone have any questions? If not, I'm going to mute you, okay? With the floating exchange rate regime, you don't have to worry too much about having to adjust your currency value anytime the market deviates from the original value anymore. But in this case, you've got to be open to exchange rate volatility, right? So when you let market supply and demand determines your currency value, then your currency value is going to fluctuate a bit. So I guess what you need to understand in this chapter is that you've got to understand the pros and cons of different monetary systems and the implications of these systems for, say, for example, for international trade or for the balance of payments, okay? So, for example, I could make up a question like, let's say Japan, right? They follow a fixed exchange rate regime. And if they want to encourage more exports, what are they going to do with their currency? Okay. So that is the kind of question that you could expect in the exam. Okay. We also talk about the importance of the European Union and the euro. So we mentioned before that with all of these different exchange rates, right? So one of the reasons why the exchange rates were fixed in the earlier stage was that people wanted to promote international trade, right? So when you have a very stable currency value, it actually is very good for international trade because people know how much they are going to exchange currencies with certainty. So with the European Union, they introduced the euro for that purpose, right? So the purpose of having the euro for a common currency for their member countries was to allow cross-border trades to happen with ease, okay? So you don't have to worry about foreign exchange rate risk if you trade with your member countries, okay? Because everyone will be trading the euro. Finally, we discussed some currency crisis. So I think we talk about the Asian currency crisis in class, and we also introduced the Argentina peso crisis, I guess. So in both of the crises that we talk about in class, the main common feature was that the currency, either the Thai baht or the Argentine peso, they were fixed against the USD, right? So as soon as you have a fixed currency value, you've got to make sure that you can maintain that fixed level. So when the market value deviate from that fixed level, and when people realize that, then they will start to panic and they will start to run on your currency, okay? So the crisis in the past highlighted the problem of the previous exchange rate regime in the sense that with the fixed currency regime, it's a bit, it puts a lot of pressure on the central bank to make sure that the currency stays fixed, okay? So I guess if this topic goes into your exam, it will be a theory question, yeah? So it will be an application on currency crisis or on monetary policy, okay? So an example of how, hang on, let me talk about chapter 3 first, and then I'll go to the example. All right, so in chapter 3, we introduced the balance of payment, and this chapter is very much related to the previous topic where we talk about monetary systems, okay? So the balance of payments is how a country can record international trades, and this follow a double entry bookkeeping. So anytime when you receive money from outside, when you have a cash inflow into your country, then it is recorded as a credit. And anytime when you have to pay, then this is the debit. Okay. So if so with this chapter as well, if it comes up in the exam, then it will be a theory question, right? So an example of how this topic can come up in the exam is the following question. So for example, here I have a question about the trade war. Okay. So if you remember last year, that was when the trade war between China and the US happened. And what happened was the USD, I mean, the USA started to have some trade barriers on Chinese goods. And then the Chinese government, in response, they devalued the yuan, right? So in this question, we've got a situation where China devalues their yuan. And the question asks to explain why the Chinese government adopted this policy. And second, what do you expect would happen to China's balance of payments? Okay. So for this kind of question, it is likely to be a 7.5 mark question for Part B. Okay. So you're looking at about 15 to 20 minutes to answer the question. So there are two parts of the question, and you've got to answer them. You've got to think about these questions in the context of monetary systems as well as the balance of payments, right? So for this question, the suggested answer is as follows. So when a country devalues their own currency, what happens is they make their currency cheaper relative to their trade partners' currencies, right? So when you devalue the yuan, the value of the yuan relative to the USD will also depreciate. So what happens is it makes goods and services from China cheaper, holding everything else constant, and it will encourage exports for China, right? So in the context of the trade war, this is a move that was attempted to counter effect the impact of tariffs on Chinese goods, okay? So when you have tariffs on foreign goods, the impact of that is it's going to make the foreign goods more expensive in your domestic economy. So by devaluing the Chinese yuan, the Chinese government has made their goods cheaper to counter effect the tariffs. Okay. So the second part of the question asks about the balance of payment, right? So what are the implications of this policy on Chinese balance of payments? So when we talk about the balance of payments, you're going to have to think about the impact of this policy on three different accounts, okay? So you've got your trade account, which is your imports and exports. Then you've got your capital account, which is the capital flow between different countries. And then you've got the foreign reserves, right? The official reserves. So in the context of the Chinese policy, so China has followed a fixed exchange rate regime, right? So the implication of a fixed exchange rate regime is that they don't really allow capital flows to freely flowing from and to China. So as a result, these are the different impacts of this policy on Chinese balance of payments, okay? So in terms of exports and imports, this is quite straightforward. So when you have a devaluation of your currency, it makes exports more, easier and import more expensive, right? So as a result, it increases your exports and it decreases your imports, okay? in terms of the capital account, this is where you've got to understand the capital restrictions of the Chinese government, right? So since China imposes restrictions on capital flow, a yuan devaluation might not have any impact on the capital account because they are not allowed to flow anyway, right? Finally, with their official reserves. So when, because the exchange rate in China is fixed, so when the government wants to devalue the yuan, they've got to change their foreign reserves, right, to make sure that happens. So how do you devaluate the value of your own currency, right? So one way you can do that is you can increase the demand of your foreign currency, of your trade partner's currency. So if I demand the USD more, then the USD value will be more expensive, right, relative to the yuan. So by increasing my foreign reserves, I can devalue my own currency, right? So this is an example of how a theory question would look like. So you've got a context and you've got to analyze how the implications of a certain issue, right? Any question with this theory question? So with the theory question, sorry.
I just have a question. Like, do we just have to write the answer for theory questions, or do we have to provide a source as well, like a reference?
You don't have to provide a source.
We have to provide, yeah?
No, you don't have to.
Oh, okay. Yeah, thank you.
Yeah. So this is similar to a paper exam where you just have to write your own answer instead of having to provide a reference. Okay.
Yep. Thank you.
And you only have 15 minutes anyway, so that's not reasonable to expect.
Right. Yeah.
Yeah. So in terms of the theory answer, I don't expect like long essays at all. So this is only a 15-minute question. So I guess what I expect is a straight to the point answer. Okay. So for example, you can start with the reason why the Chinese government adopt this policy is because blah, 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 blah. And then go to the next page, next paragraph. And then this is what I expect to happen to the Chinese balance of payment. Okay. So number one, account, trade account. Number two, capital account, so on and so forth. So no need to write an essay. You just have to be straightforward and answer the question. All right. All right. So so typically chapter 2 and 3 tend to go hand in hand. So normally a question that asks about the balance of payments tend to be related somehow to the monetary system. Okay, so just bear that in mind. Chapter 5, the market for foreign exchange. So in this chapter, the main focus that we talk about was firstly the spot exchange rate market, where people exchange currencies in the current time, right? So in this chapter, we talk about a few things. The first question is how does banks record international transactions between themselves? I guess this is not too important, right? So I guess some of the questions in the multiple choice section might reflect this question. So this is where we talk about the corresponding banking relationship, right? But the main focus of chapter 5 is mostly on how the spot foreign exchange market works. Okay. So different quotations, how to read the bid and ask spread, so on and so forth. Which rate do you trade if you're a dealer or if you are a customer, right? So chapter 5 forms the backbone of all of the calculations that we do later on, okay? So make sure that you understand chapter 5 very well. In the next chapter, which is chapter 7, we talk about foreign exchange derivatives, okay? So for the purpose of the revision, I'm going to group forward, futures, and options together. But bear in mind that with the forward contracts, we talk about it in more detail in chapter 5, okay? So by definition, derivatives contracts are contracts that have contingent values. That means their value is derived from an underlying asset, okay? So in the context of foreign exchange derivatives, the contract values, the derivatives contract value is dependent on the foreign exchange itself, okay? So for example, if I buy a forward contract on the pounds, then the value of the forward contract will depend on the value of the pounds later on, okay? So with forwards and futures, they have exactly the same payoff, okay? So the way that their contracts are set up are very similar. So if you buy a currency forward, it's going to be very similar to buying a futures contract on that currency, okay? So forwards and futures are agreements to buy and sell foreign currencies in the future, right? So you settle the contract in the future, but you agree on the prices today. So what you know for sure with this contract is the price at which you settle the contract. So as a result, because you know for sure what is the price of the currency in the contract, these contracts, the forwards and futures contracts, they are used for hedging purposes a lot, okay? So some of the terminologies that we are used to, if you have to sell something forward or if you have to sell a futures contract, then you're short, you go short. And if you buy something, then you are going long, okay? So how do I know when to short or long a foreign exchange forward or futures contract, right? So the decision on whether long or short a contract will depend on their payoff function, okay? So if I expect, for example, if I look at the left graph, if I expect the future exchange rate to increase, right? So if it's going up, then I'm going to long a forward contract, right? Because when it is actually increasing, I will make a gain on my forward contract. In contrast, if I look at the right-hand side graph, if I expect the future exchange rate to decrease, so if I'm looking at the left-hand side here, then I will be shorting a futures or a forward contract, right? Because then I will gain here. So to put the payout functions of different contract positions into words, then for a long contract, the payout function is given by ST minus F, okay, times the notional value of your contract. So where does that come from? So your profit function is given by the difference between ST and F times the notional amount, right? So in other words, if you look at the long forward contract, it allows you to buy, right? It allows you to buy the currency at a fixed rate of F. So when the market rate is higher than F, it will be better off for you to exercise. Why did I say exercise? So it would be better off for you with the forward contract. And how much are you better off? It is given by the difference between how much you buy under the forward contract and how much you have to buy in the spot market if you do not have the forward contract. All right. In contrast, for a short position, your payoff function is the opposite. So F minus ST times the notional value of the contract. Okay. So if I were to speculate using a forward contract, then I'll be comparing my expected future exchange rate and the forward rate, right? So if I think that in the future, the exchange rate is going to be higher than the forward rate, then I'm going to be long a forward contract and vice versa, right? Now, in terms of hedging, if I need to use forward contracts to hedge a foreign exchange rate exposure, then how do I make a decision, right? So whether I long or short if I want to hedge. So the answer depends on your underlying position, right? So for example, if I have an account payable, which means in the future, I'm expecting to pay a foreign currency, right? So here I'm talking about hedging. So if I expect to pay a foreign currency in the future, what I worry about is the future exchange rate is going to be higher, right? So I don't want the future exchange rate to be high because in that case, I will have to pay more for the same account payable. So I do not want exchange rate to increase. Because then I will make a loss. So if I have to pay more for the same account payable, that means I am worse off than before. So I can say that I make a loss on this account payable. So to hedge this position, you want to enter into a forward contract that will make a financial gain when exchange rate increases. Yeah. So that the gain in your forward contract can be used to offset the loss in your underlying position. Okay. So in this case, if I want a contract that gains when exchange rate increases, then I would be looking at a long forward position. Okay. So here I will gain when exchange rate increases. Yeah. So to hedge an account payable, I want to be entering into a long position on a forward contract or a futures contract. In contrast, if I have an account receivable, if I expect to receive a foreign currency in the future, then in this case, I do not want the exchange rate to depreciate, right? So when the foreign currency depreciates, I will exchange the foreign currency for less in my domestic currency. So I do not want the exchange rate to depreciate. So in the second case with account receivable, you will be worse off if the exchange rate depreciates in the future. So what you want to do is you want to enter into a forward or futures position that gains when that happens, right? So a position that gains when the exchange rate decreases is a short position, right? So as a result, for an account receivable, you want to hedge using a short futures or forward contract, okay? So in the exam, I think, so when a hedging question comes up, the first question is always, do you long or do you short a forward contract, right? So it's important to understand the idea behind why you want to long or you want to short, okay? So we mentioned before that with futures contracts, their payoff functions are going to be exactly the same as a forward contract. But what we have to bear in mind is that futures contracts are traded on exchanges, right? So they are settled, they don't just get settled at the end, but they are marked to market every day, right? So with exchange traded contracts, your account value is revaluated every day. So in terms of terminology, with futures contract, you've got to have a performance bond before you start trading, which means you have to have like a margin account, right? So this is similar to a margin account where you have to deposit some money, a fraction of your contract size, before you can trade a futures contract. What is the maintenance level? So the maintenance level in a futures contract is the minimum value that your account can go below. Okay, so for example, so this is your account, right? So before you can trade any futures contract, you've got to deposit, let's say, $3,000 in your account. Now, the maintenance level is something below that. So, for example, the exchange asked me to maintain a minimum of 1,500, right? So the maintenance level on this account, on this particular product, is $1,500. So whenever my account makes a loss that is greater than 1,500, so that my account value goes below 1,500, this is when I have to top up my account, okay? So the value in my account should not go below the maintenance level. What happens if my account balance fall below the maintenance level? So as we mentioned before, if your account is somewhere below the maintenance level, you've got to make a deposit. So you've got to top up your account back to the initial level. So in this topic, so one of the calculation questions that you could be asked is you've got to illustrate how profits and losses are recorded in a futures trading account, right, for the day-to-day market-to-market process. So for example, I could be giving you the closing price of a futures contract on 3 different days, for example. And then you've got to calculate for me the profit and loss of each day, and then the closing balance on each day, okay? So in other words, you've got to be able to illustrate the daily market-to-market process on a futures contract, okay? So this kind of calculation question will likely be a short 15-minute question, okay? So finally, we introduce options contracts. Yeah. So for options, I find option contracts to be more complicated than forwards and futures because you've got to make a decision to either exercise the option or not. Okay. And that makes it more complex. So with option contracts, you don't have to worry too much about American versus European, so on and so forth. For the purpose of illustration, for this subject, we would only deal with European options, okay? That means you would only have to exercise at the maturity of the option. So in terms of options, you've got call versus put, and then you've got long versus short, right? So a call option is something similar to a long forward contract. So don't be confused between the two terminologies. So a long forward contract is when you buy a certain asset, right, at a fixed price. A call option is similar. So a long call option allows you to buy a certain exchange, a certain currency in the future at a fixed price, okay? In terms of long versus short in options, a long option means you buy the option and the short options mean you sell the option, okay? So you don't sell and buy the underlying asset. When you long and short an option, you buy and sell the option itself. So most of the time we'll be talking about taking a long position in options, yeah? So when you hedge, for example, normally you will be taking a long position in either a call or put. So a long call option position allows you to exercise the option at the exercise price. Besides that, you also have the option to not exercise, right? So if you think about having a long call option, so let's say I have a long call option on the pounds with the exercise price of, let's say 1.5 Australian dollars over the pounds. Okay. So this option essentially allows me to buy a pound at 1.5 Australian dollars. Okay. So if we think about having this option, now when do we want to exercise the option? When do we want to buy the pounds under the option contract? And when do we not? So when we say exercise the option, that means we agree to buy the pounds at the agreed rate under the option contract, which is 1.5 Australian dollars. So if I have this option, right, and let's say this option is for 3 months. So in 3 months' time, if I observe that the market exchange rate is 1.4 Australian dollars for a pound. So in that case, do I want to buy the pounds under the option contract, or do I just go to the spot exchange market and buy from there?
You want to buy the cheaper option. So I think the spot was 1.4, so that'd be cheaper.
Exactly, spot on, right? So I always want to buy at a cheaper option. So if the spot market in that case is only 1.4, I'm going to just buy from the spot market. So in that case, I will not exercise the option, okay? I just go to the spot and exchange at 1.4. In contrast, if the value of the pound is traded at 1.6 in the market, and I've got this option, then obviously I'm going to be exercising it, right? So in this case, why do I have to go to the market if I have to pay more? So here, this is when I exercise the option to buy at 1.5. Okay. So because of this feature, when we plot the option payoff on the graph, we will see that they've got two different parts, right? So in the first part, this is when I decide to not exercise the option and just go to the spot market to buy. In the second part, when the exchange rate in the spot market is greater than the exercise price in the option, I will exercise the option. And in which case my payoff looks like this. Okay. So essentially what this graph tells you is that under an option contract, the maximum that you can lose is just the option premium itself. Okay. Whereas if you compare this with, let's say, a long forward contract, with a long forward, when the market moves against you, then you're going to make a loss, which could be much larger than the option premium. Okay. So potentially an option gives you a potential for unlimited upside gain, but it caps your downside risk. Okay. And this is why the option is more flexible relative to when you have a futures or a forward contract. So some of the common mistakes that I have seen people made in the past semesters is that when it comes to options, somehow the exercising decision is quite tricky. It's quite hard to get. So most of the time, people will lose marks on whether they exercise the option or not. Okay. So when you are not sure, then think about, then just draw a graph, right? And then just put the numbers in here. Let's say the question gives you that the exercise price is 1.5, and then the expected, let's say the expected future exchange rate is 1.4. So when in doubt, just draw a graph, and this graph will tell you what to do, right? So if you are on the left-hand side, then you don't exercise the option. This is when you don't exercise the option. When you are on the right-hand side, and of course you would exercise your option. Okay. So this is a payoff function. Let me erase all the ink first. So the blue line is the payoff function for a short option, short call option, right? So as I mentioned before, with this subject, we don't really deal too much with short option positions because most of the time we either want to speculate or we want to hedge our position. So for hedging, you typically will stick to a long position. But just in case you are wondering, so if you want to write the payoff function for a short call, then it will look like this. So as you can see, the short call position is the counterparty of the long call position. So their payoff function is going to be the opposite of a long call. Okay. So for a long call, your payoff is the maximum between 0 and ST minus E minus C0. So if you want to find the payoff function for a short call, you simply just have to take -1 times the function of the long call. Okay. All right, we are right at 3 p.m. So did we want to take a short 5 minutes break? And then when we come back, we can go through the rest of the slides.
Yeah, no worries.
Okay, I'll see you back in 5 minutes. Let me go back to the lecture slides. So if I have a, let's say if I think that the future exchange rate is going to depreciate, would I want to enter into a long call position? Yes or no? So if I think exchange rate is going to increase, do I want to buy a call option or not? So in this case, if I think that the future exchange rate is going to increase, I will want to buy a call option, right? Because if that's the case, then I can make some financial gains in here, right? So if the exchange rate is increasing, then I would get some profit on the call option. So in terms of a put option, it is going to be the opposite of a call option. So for a put option, you would want to enter into a long put option if you expect the exchange rate to depreciate in the future, right? So for a put option, you will gain if the exchange rate is to the left of the exercise price, okay? So a put option is an option that allows you to sell a certain currency at the fixed rate of E, right? So in this case, you get to sell at the price of E. So if the market exchange rate is greater than E, that means you get to sell higher in the market relative to under the option contract. So in this case, you will not sell the, you will not exercise the option. In contrast, when the exchange rate is less than E, so when you're looking at the left-hand side, then it's better off for you to sell the currency under the option contract at E, okay? So for a selling decision, you want to sell at a higher rate. So some terminologies as well. So when the option is profitable, so when it's profitable to exercise the option, then we call the option in the money, right? So for example, with a put option, when the exchange rate is on the left, then it is profitable to exercise the option. So the option is in the money. In contrast, when the option is not profitable to exercise, then it is out of the money, right? So for a put option, if the exchange rate is high, if the spot exchange rate is high, you don't want to exercise, okay? So in this case, the option is out of the money. Similar to before, so with a short put option, it is just the opposite of a long put option. So your payoff function here is simply just -1 times the payoff of a long put option. Okay. So it's similar to before. So if I expect the exchange rate to depreciate in the future, if I expect exchange rate to depreciate, that means I think the left-hand side is more likely to happen, right? So in this case, I want to be buying a put option because if my expectation is right, then I've got a chance to earn profit here. Okay. So similar to a long call option, if you have a long put option, then you are also, so you cap your maximum loss, right? So you can only lose as much as the option premium, but your upside gain is not capped, right? So in this case, you've got the potential to earn a lot of profit, whereas the minimum loss is already capped. The maximum loss, sorry, the maximum loss is already capped. Okay. So options and futures and forwards, of course, they are very important for later chapters when you talk about speculation or hedging, right? Using these derivatives contracts. So in the final exam, it is very likely that you are going to get 1 or 2 questions in part B, or even 3, talking about one of those derivatives contracts, right? So make sure that you understand them well so that you can do well in the exam, okay? So moving on to the next chapter. So with this topic, we talk about the international parity conditions. And the purpose of this topic is to relate the exchange rate with other macroeconomic conditions, right? So the purpose of this topic is for forecasting exchange rate. So the idea here is that we don't know what the future exchange rate looks like, but if we can understand the relationship between exchange rate movements and, let's say, interest rates or inflation rates, then maybe we can forecast exchange rates using the existing macroeconomic conditions, right? So, for example, with the interest rate parity conditions, this is an equation that describes the relationship between nominal interest rates and exchange rates, okay? So the relationship between these 2 factors are given by this equation here, or any kind of different rearrangements of this equation. So if this holds true, if this is the truth, then if I can obtain the interest rates in 2 different countries, and if I can also obtain the current spot exchange rate, I can use these as input to compute the forward rate, right? The forward exchange rates here, or the expected future exchange rate, whatever you like, right? So the idea here is I can use the other macroeconomic conditions to compute a forecast for future exchange rate movements, okay? So this is something that we have done in our assignment. So if it comes up in the exam, then I'm sure you're gonna be fine in here. So how do you prove it? With arbitrage, of course. So the idea here is that this equation has to hold, otherwise arbitrage or mispricing will happen. And as people arbitrage away these mispricing activities, opportunities, then the equilibrium will be back to balance, okay? So in terms of this topic, if it comes up in the exam in part B, so I'm talking about part B here, then this kind of arbitrage question is more likely to be a 7.5 mark question, right? So 15 minutes for this question. So for this topic, most likely you're going to have a calculation question in part B for this topic. If there is any theory question, I guess it will form part of a bigger question that includes both calculation and theory, right? So there's not much theory to ask in this topic, I guess. All right. So besides the IRP, we talk about other parity conditions like the PPP, IFE, so on and so forth, right? So the key idea here is, as I mentioned before, is that you want to be able to forecast future exchange rates using other macroeconomic conditions, okay? Forecasting techniques. So besides the approaches that we talked about before, we can also look at different other types of forecasting techniques like the efficient market approach, fundamental approach, and technical analysis, right? So once again, if some sort of theory question will come up in part B, it's likely to be a small part in the bigger question, right? So for this topic, I guess most of the time you should focus on calculations rather than theory. Right. So moving on to the next big topic, which is foreign exchange rate risk exposure and management. So this is a very important topic because you will likely to see it in part B, right? So with part B, you'll be focusing on hedging either transaction exposure or economic exposure, right? So make sure that you are on top of these concepts. In terms of theory questions in this chapter, you could be asked something about hedging strategies, natural hedges, for example, relocation to different countries, so on and so forth, right? So there could be some theory questions on this chapter. But the big question is going to be on calculation, okay? So transaction exposure is something like when you have a specific transaction that you know for sure when it's going to happen and how much you are exposed to, right? So for example, when you expect a foreign trade partner to pay you in 3 months' time, right? So let's say £1 million, for example. So that is an example of a transaction exposure. Economic exposure, on the other hand, is when you focus on the entire firm value or asset value relative to just one single transaction, right? So for these different types of exposures, you need to understand how you can use financial instruments to hedge these exposures, yeah? So if these kind of concepts come up in the exam, it is going to be a big question. So it's going to be like the 15-minute question. Not 15 marks, sorry. So it's going to be about 30 minutes. Okay. So to do well in this topic, you've got to understand very well the derivatives contracts that we talked about before, right? Especially with transaction exposures. Okay. So the last topic that we introduced in this subject is international banking and monetary and money market and financial crisis, right? So this topic is very theoretical. And so if it comes up in the exam, you would expect a theory question for about 7.5 marks. So in this topic, the main, I guess the main points to focus on is on the second half of the lecture. So I don't really care too much about the different banking structures, so on and so forth. What I care about are the different financial products, like the notes or the interbank financial money market instruments, forward forward rate agreement contracts or the futures contract on interest rate, right? So you want to understand these financial products in detail. Especially, you want to understand how to hedge interest rate risk using forward rate agreements or futures on interest rates, right? So these are the important points. In terms of the overall picture of this chapter, I need you to understand how the international banking sector works, right? So when we say international banking, we're talking about banking activities across the border, okay? So for these activities, people trade in the euro-dollar market, in the euro currency market, right? So when you have to trade your currency outside of your country, then that is the euro currency market, okay? You've got to understand how this sector is regulated, okay? So you've got to understand the settings of the Basel standards and how it changes over time. Finally, so we introduced 2 debt crises at the end of the chapter. So we talk about the GFC 2007, and we talk about the Latin American debt crisis in 1982, right? So for these 2 crises, it's very important that you understand how the crisis took place, what were the causes, right? So what were the main causes of the crisis and how they were resolved. So for the Latin American debt crisis, for example, the main problem was the banks did not diversify their portfolio, right? So they concentrated too much on one segment of the market, which is the Latin American countries. For the GFC, the main cause was the banks' excessive risk-taking in the subprime mortgage market, okay? So an example of how a theory question can come up in this topic is, for example, so how does regulation play a role in the GFC, right? So let's say if I ask you a question like that and you have to answer in 15 minutes, how are you going to answer that question, right? Yeah, so the type of question that you would expect in this topic is either a application question where you've got to discuss a certain aspect of the crisis, or second, you can be asked a calculation question that involves either the forward rate agreement on interest rates or the futures contract on interest rates, right? So these are the 2 that we covered in class last week. Okay. So like I mentioned before, with part 2, you've got 3 questions. So one is a big calculation question for 15 marks and 2 are smaller questions. So one of them could be a theory questions for 7.5 marks, okay? So for any kind of theory questions, you're looking at about 15 minutes to 20 minutes, okay? All right, so I have gone through the main sort of topics, the main points for each of the topics we introduced in class so far. And I talked about different kinds of questions that you might see in the exam. Any questions so far, guys? If not, I'm going to move on to the examples, okay? So in the next few slides, I'm going to have some revision questions. And what I have here on the slides are some of the tricky questions, or some of the questions that I find that students tend to struggle with in the previous semesters. So these are not a suggestion of what to come up in the exam, okay? So don't think that the exam will cover exactly the same questions like this. So I just wanted to illustrate some of the possible exam questions. So the first question that I took out from our tutorial questions is a question about transaction exposure, right? So in this case, we've got a transaction between two trade partners. We've got an American company and we've got a Swiss client. So this American company is a seller of a product, and the Swiss client buys the product from them. So the American company allows their client two options in terms of payment. So they could either pay $10,000 or they could either pay 15,000 Swiss franc, okay, in 3 months' time. So in 3 months' time, you either have to pay $10,000 or you would have to pay 15,000 Swiss franc. Okay. So for the American company, then if they receive the dollar, then obviously then they don't have any exchange rate exposure here. But if they receive the franc, this is when they have to worry about exchange rate exposure, right? So with this kind of question, the length of the question is not too long, I think. So if it does come up in the exam, it will be for about 20 minutes, right? So yeah, so this is about 20 minutes if I set up an exam, right? Or a test or something like that. So essentially, in this case, the seller, the American company, gives their client an option, right? So this is the free option given by the American company. So this Swiss client either can pay in the dollar or in the Swiss franc. Question A is quite straightforward. What is the implied exchange rate, exercise exchange rate for this option, right? So in other words, under this option, what is the value of the franc in the dollar or vice versa? So in this case, what you can do is you can simply just take the dollar amount divided by the Swiss franc amount, right? So it's not too difficult. Yeah. I'm just going to write 10 divided by 15. So if I take 10 divided by 15, that will be 0.67. Okay. So essentially, in question A, we have found out that if the Swiss client takes up this option, they essentially will exchange the franc for $0.6667. Okay. Question B is a bit more tricky. So in this case, if the exchange rate turns out to be $0.62 per franc, which currency do you think the Swiss client will choose to use to pay for the payment? Okay. And what is the value of the free option for the Swiss client? So I find this question to be quite intuitive in the sense that you just have to evaluate different options for the Swiss client, right? So if I'm the client, I've got two different ways to pay. I could either pay 15,000 Swiss franc in my own currency, right? So I don't have to worry about exchanging for the dollar at all. In the second option, I will have to exchange the franc into the dollar first to pay $10,000. So with the first option, I'm just going to pay 15,000 franc. That's it. For the second option, because I'm a Swiss company, I've got to exchange the Swiss into the dollar first before I can pay $10,000. Okay. So in the second option, I'm going to be exchanging the Swiss franc for $10,000. So at the exchange rate of $0.62 per franc, this is how much Swiss franc I have to exchange, right? Okay. So the second option looks a little bit more expensive for me, right? So if I choose to pay $10,000, then I'm going to have to pay 16,129 Swiss franc for that. So in this case, because I'm paying, I want to pay lower. So I'm going to choose the first option. Okay. The value of the option, the value of this free option for the Swiss client is therefore the difference between how much I pay under this option and how much I would have paid if I have to pay in the dollar, right? So this is how much I'm better off. So if I take this and I minus this, then I will get a value of 1,129 Swiss franc. Okay. So for this Swiss client, the value of the free option is how much they save, right? And that is 1,129. Question C is also quite tricky. So in question C, you've got to understand how to identify an exposure and how to use financial derivatives to hedge your exposure. Okay, so the first step is very important. You've got to identify where your exposure lies. Okay. So in this case, let's think about the position of Baltimore Machinery, right? So basically, this company has given their client a contingent or an option, right? So they don't know what they get yet until their client pays. So they could be either paid $10,000, in which case they don't have to worry about exchange rate exposure at all. Or in the second option, if they get paid 15,000 Swiss franc, this is when they have to worry about the exchange rate exposure. Okay. So the nature of this exposure is that it is contingent. Yeah. So you would only have an exposure if the client chooses to pay in the Swiss franc. Okay. So this is a contingent exposure. So if you think about hedging this exposure using a forward or a futures contract, the problem here is you're going to have to stick to your contract regardless. Okay, so it doesn't matter if your Swiss client pays you in the dollar or in the Swiss franc, you would always have to exercise your forward contract. So for a contingent liability or a contingent asset, you do not want to do that, right? Because there's a situation where you don't have to hedge your exchange rate risk. So when you have a contingent exposure like this, a better way to deal with it is to enter into an option contract, right? So in this case, because this is contingent, an option would make more sense than a forward or a futures contract. Now, we have decided that we want to use options rather than futures or forward. The next question is, what kind of option should I buy, right? Should I buy a put or should I buy a call? So in this case, now if the client pays me 15,000 Swiss franc in 3 months' time, and I want to convert it back into the dollar, the best way to hedge this is to use a put option, right? Which allows me to sell the Swiss franc for the USD. Okay. Does that make sense? So if I have a put option, then whenever the Swiss franc depreciates, which means I'm going to lose out on my account payable, then I can exercise the option to sell the franc at a fixed price of E. Okay. So in other words, for question C, the best way for me to hedge this exchange rate exposure is to use an option contract to allow me the flexibility to only use it when I need to. And what kind of option do I use? I'm going to use a put option, right? Because this is an account receivable. Okay. All right. Question 2 is a transaction exposure as well. And this question is very typical for a 30-minute question, right? So this is the length that you could expect for a 30-minute question. Yeah. So in this case, what you've got to do is you've got to hedge a position using different financial hedging tools, right? So here you've got to use the money market hedge, forward hedge, as well as the option hedge, okay? So for 30 minutes, you've got to make sure that you can solve this question within that 30 minutes, okay? 30 to 35. Right. So for this kind of question, the first thing you read the question, when you read the question, the first thing you want to find out is you want to find out what the question is about. Okay. So in this case, you've got a transaction that is expected to happen in 1 year's time. Okay. And the question asks you to hedge this transaction. So this is a transaction exposure hedge. Right. So once I've identified the type of question I'm dealing with, the next thing I want to do is I want to find out more about this transaction. Okay. So here I've got a American company again, and this company owes a foreign entity some money, right? So this is going to be an account payable in the yen, so in the foreign currency. What else do I know? I know the current spot rate, I know the forward rate, I know the interest rates in 2 different countries, right? I also know that there is an option contract available for me if I use option to hedge. Okay. So this kind of question is now become very straightforward. I know what I need to do, which is I need to hedge an account payable in the yen. I know what the question required me to, what financial hedging instruments that I am required to use to hedge this exposure, right? So for money market hedge, you could either follow the same approach that I showed you in class, where you identify what kind of cash flow you need at the end to work through to reverse engineer the transactions, or you could look at the lecture slides and use the step-by-step instructions in the lecture slides for money market hedge, right? So this is not a problem. Forward hedge is also quite straightforward, right? So by now, we would already know if we want to hedge an account payable, what kind of forward position we want to enter, right? So here I have an account payable. So to hedge this position, I want to be long in the forward contract, okay? For 500 million yen. Okay, so question A is not very tricky. You just have to apply the steps, I guess, in the calculation. Question B is also quite straightforward. So here, assume that ST is equal to F, which is the forward rate. Then if you use option hedge, what is the dollar cost of meeting this obligation? Okay, so option hedging cost. So once again, this is something that we have gone through in class. And this is something we've done in our assignment as well. So by now it should be, you should be quite familiar with this calculation. So once again, with option hedge, just be careful of the exercise price, okay? So the first thing you want to identify is whether you exercise the option or not. And that will determine how much dollar cost you've got to pay to meet this obligation, okay? Question C could be a bit more difficult. So for question C, you've got to find X, which is the exchange rate for the option hedge, okay? At which you'll be indifferent between option and forward. So this is not very straightforward, but this is something we have done in class before. So if it does come up in the exam, I hope that this will not trouble you too much, okay? So I won't go through this question in details because we've gone through this in class before. But you've got the solutions here if you want to. So in terms of the exam, because you are timed, just make sure that you are efficient, right? So I think when you read the question, the way to be efficient is to identify from the big step to the small step, okay? So you want to find out the topic first, and then you want to find out what you're dealing with, and then everything will just fall into places, okay? Also in this kind of, so when you deal with like a hatching problem, one of the common mistakes is that people don't pay too much attention to the time, right? So in this case, if I got a 1 year hatching horizon, then I'm going to be using the 1 year interest rates, right, in 2 different countries. But if I have, let's say, a 3-month hedging horizon, then you've got to make sure that you adjust the interest rates accordingly, right? All right. This is something we have gone through before about the theory question, yeah? So once again, with the theory, I'm not going to ask you a straightforward definition question. I'm going to ask you an application type of question, okay? So for the theory question, if you want to do well, you've got to make sure that you understand the topic, right? Okay, it looks like we have sort of finished our class very soon. So in terms of the further revision, as I mentioned before, with the poll on the LMS, it looks like people prefer to have another workshop organized for Monday the 26th, sometime from 10 to 1 p.m. On the other hand, I am aware that there are people that prefer different time, as well as people that prefer to have one-to-one consultation, right? So I guess based on the poll results that we've got on LMS, what I'm going to do is I'm going to arrange a revision workshop on Monday the 26th, right? Because it's the most popular choice. Now, for this revision workshop, instead of me going through whatever questions I pick, which could be quite random, how about you send me the questions before class, right? So if anyone who intends to attend the revision workshop on Monday, can you please send me a list of questions that you want to go through in that revision class so that I can prepare the slides and go through the questions with you in class, okay? So depending on how many questions I have for that revision workshop, this can run from 1 to 2 hours, okay? So from 10 a.m. to either 11 a.m. or 12 p.m. It's up to you guys. In addition to this, I'm going to arrange some one-to-one consultation as well. So if you want to have a one-to-one consultation instead of going to a revision workshop, you can email me and book an appointment at any time during these 2 times, okay? So I'm available on Wednesday that week from 10 to 12 or on Friday from 2 to 4, okay? So if you do want to have a one-to-one consultation, then make sure you book me during those times, okay? In terms of email answers, I'll try to be as efficient as I can, but I've got other things to do as well. So I do prefer that if people have questions, I do prefer to have a one-to-one consultation rather than answering emails, okay? Anything else I want to say? Yeah, I guess so. From my experience, I don't think students will start revising 2 weeks before the exam or 3 weeks before the exam. So the most realistic time that the revision workshop will be beneficial is sometime a few days before the exam. Okay, so if by Friday the 24th, if I don't get a lot of questions from you guys, then I might decide to move the revision to another day, right, closer to the exam, if that suits everyone better. But yeah, so if you need my help, then feel free to book appointments or discuss with me through email. All right. Anything else? Yeah, so I want to talk about the structure of the exam a little bit, right? So I noticed that with the multiple choice questions, people tend to do better relative to short answer questions. And so, so the way I structure the exam is that I've got enough multiple choice questions to make sure that you guys can, if you practice enough multiple choice questions, you should be able to get to pass the subject with ease. So assuming that you do well in part A, then with part B, you would only have to like get another 5 to 10 marks to pass the hurdle rate, right? So don't stress out too much, I guess. The exam will not be surprising, but you do have to study to be able to pass the exam, okay? Yeah, so I think that's all that I want to say about the exam. Any questions at all, guys? No? Okay.
Yeah, no questions. Thanks for
Okay.
your teaching this semester. It's been great.
Thanks, James. Thanks for turning up. All right, so it looks like we don't have any more questions, but once again, I'll be available from now until the exam. So make sure that if you do have any questions, ask me or book a consultation. I do hope that everyone do well in the exam. Okay, so if there's no more questions, then allow me to conclude the class for now. Thank you so much, guys, for turning up this semester. I know online study is not great, but thanks so much for still sticking up with it. All the best with the exam. And if you do graduate this year, then all the best with job hunting next year. Otherwise, if you have 1 or 2 years left, then hopefully we will see each other face to face next year at uni. Okay.
Thank you.
Thank you so much.
Thank you. So I'm going to conclude the class for now.
Thank you, Professor.
Thank you. Thank you.
See you guys.
See you. Bye-bye.
Bye.
Bye.